So just call me Bond. Municipal Bond. Yeah, that joke killed at the accounting firm.
So this won't be a super long video, but I felt the need to put out a warning on bonds just in general. So they used to be a very reliable way of getting a fixed income for your portfolio, but things have changed massively since they were originally created. So to put it simply, bonds are just IOUs, and there are so many different types of bonds, but they're typically issued by companies and government entities. So how could a bond be a bad investment? These are just debt instruments, right? You're going to get your money back at the end of the hold period. So what's the problem? Well, it has to do with the fact that most investors do not hold a bond to maturity. Oftentimes they're selling these before they mature, unintentionally. So when you are signing up for your 401k or you're opening up a brokerage account, there are these things called target retirement funds. And these target retirement funds are automatically allocated based off your age. So if you're 25 years old, sometimes they'll have around 25% allocated towards bonds and 75% allocated towards equities. This has historically been a safe way of creating risk mitigation. It's called like the bucket strategy. So, if stocks go down, well, your bonds, you could sell those and buy stocks on the cheap and vice versa. But we find ourselves in a low interest rate environment, the lowest in history. So when you have a debt that you've bought and you're getting paid 2% interest, and in the future, if a new debt comes out and it's paying 3% interest, well, that 2% bond lost value. Because why would you buy that if you could just buy a new bond that pays 3%? You wouldn't. So you would expect a discount. So if you're selling that before it matures, you have to basically discount that price. And all of this is happening automatically within these bond funds. Because we're at historic low interest rates, a lot of companies are issuing bonds like they've never done before. But there's multiple components to a bond. There's the interest rate, the face value, but there's also a risk rating. And if a corporation issues a bond and maybe they don't hit their earnings or maybe they're going to struggle financially, that actually affects the price of the bond when you're trying to sell it. Remember, you're not holding these to maturity if they're part of a bond fund. They're going to be bought and sold without you even knowing that it happened. So if the corporation is doing bad and their ability to pay back that bond goes down, then you have some stock market risk embedded in that bond. Why does this conventional wisdom exist? If you're 25 years old, 25% bonds, the rest in stock. If you're 50 years old, 50% bonds, the rest in stock. Well, the reason why that worked in the past was over the last 30 or 40 years, we had continuous drop in interest rates. And think about it, if you have an older bond that's paying 8% and there are new bonds that are being issued that pay 5%, wouldn't you rather have that 8% bond? Wouldn't you be willing to pay a premium on the face value to get that interest rate? That's why it was a surefire way of having kind of predictable growth in your bond allocation. But with it going the opposite direction, things starting off cheap and getting more expensive, you're only going to see losses in value in the long run. And who knows? The government may be able to bring interest rates down to negative values like they've done in Europe, and you could still see some appreciation. But that's uncharted territory. The whole negative interest rate thing is very new, and we don't know how it's going to shake out. So I just wanted to put this out there so that if you have target retirement funds in your portfolio, I'd encourage you to just look at what the bond makeup is, and for you to make an informed decision on whether you want to expose yourself to not only interest rate risk, but also stock market risk if they're majority corporate bonds, but also inflation risk. The dollars is it worth being paid 2% when we have a real risk of inflation in the market right now? So if you found this video helpful, please like and subscribe and share it with others who you think would find it beneficial. And if you have a different take, leave a comment and let me know your thoughts. I hope I'm wrong. I hope I'm missing something big, but it seems like almost like a guaranteed loss for investors in the long run. So that's all I wanted to say. Thanks for watching.